I want you to understand that there are growing problems inside the private credit market, and this is another warning sign of how fragile the economy really is right now. I want to break this down clearly because this part of the financial system matters more than most people realize. Before we get into the latest stress signals, let me first explain what private credit actually is. In the past, when companies needed to borrow money, they usually went to banks. Banks would issue loans, and businesses relied on those loans to fund operations, expansion, and working capital. But after the 2008 financial crisis, regulators imposed stricter rules on banks. Banks were required to hold more capital, and they became much more careful about lending. As a result, a large part of business lending shifted away from banks and into the hands of investment firms. Instead of traditional banks making those loans, major asset managers and credit funds stepped in. Firms such as Blackstone, Apollo Global Management, Ares Management, Blue Owl Capital, KKR, and BlackRock began raising money from investors and then lending that money directly to companies. That is what we call private credit. This market has expanded very quickly. In fact, private credit has become one of the fastest growing parts of the financial system. It is now roughly a $3 trillion market, and it includes direct lending to companies, asset-backed lending, real estate credit, infrastructure debt, and distressed credit funds. The reason investors were drawn to private credit is pretty simple. These loans usually offer higher yields than traditional bonds. In many cases, investors were earning 8%, 10%, or sometimes even more. During the years when interest rates were extremely low, those returns looked very attractive. But the environment has changed sharply. Interest rates are now much higher than they were just a few years ago, and that is where stress in the system is starting to show up. Here is why this matters. Most private credit loans are floating rate loans. That means the interest cost for the borrower rises when interest rates rise. When rates were near zero, that was not a major issue. But over the past few years, the Federal Reserve increased interest rates aggressively to fight inflation. As a result, borrowing costs for many companies jumped. Some businesses that were paying 4% or 5% on their debt are now paying 10% or even more. That is a massive increase in interest expense. And for companies that already carry a lot of debt, that can become a very serious problem very quickly. Several warning signs now suggest that financial stress among borrowers is increasing. Credit rating agencies have reported more downgrades than upgrades for companies that depend on private credit. In simple terms, more companies are now being viewed as financially weaker. At the same time, delinquency rates and default rates are moving higher. Right now, estimates suggest private credit default rates are around 5% to 6%, which is above historical averages. That said, these levels are still well below what you would normally see during a major financial crisis. So yes, defaults are rising, but for now, the situation is still considered manageable. Another issue getting a lot of attention is liquidity, and this is very important. Historically, private credit funds raised money mainly from large institutional investors such as pension funds and insurance companies. Those investors usually committed their money for long periods of time. Because of that, fund managers did not have to worry too much about investors suddenly asking for their money back. But that has started to change. In recent years, more private credit firms began offering products to wealthy individual investors. These are often called semi-liquid funds. They allow investors to request withdrawals at certain times, such as once per quarter. On the surface, that sounds reasonable, but it creates a mismatch. The loans inside those funds may last 5 to 7 years, while investors may want their cash back much sooner. That is where the pressure begins. Recently, some private credit funds have seen higher redemption requests, meaning more investors are asking to withdraw money. And this issue was already showing cracks in 2025, but it has continued building in 2026. You may have heard about the redemption pressure involving Blue Owl. That caused concern. Now, other firms are also making headlines, including BlackRock, Cliffwater, and names tied to large institutions such as Morgan Stanley. And those are only a few examples. To be clear, major giants like BlackRock and Blackstone will probably be fine. These are enormous firms with deep capital and broad resources, but some smaller or less resilient institutions could face real trouble if pressure keeps rising. Now, I want to be very clear about something. These are early warning signals. We are not in the middle of a full financial crisis. This is not panic mode. The loans inside many of these funds are still performing, default levels are still moderate, and redemption limits are built into the structure of these funds. So the existence of redemptions alone is not shocking. What matters is the scale. That is the real concern. If one institution faces a wave of withdrawal requests, that may be an isolated issue. But if several major firms start facing withdrawal pressure at the same time, that becomes a red flag. These funds are not necessarily bankrupt. The deeper problem is that investors want their money back faster than the underlying loans are being repaid. That is the core mismatch. Now let's step back and look at the bigger picture. Why does any of this matter for the broader economy? The answer is that private credit has become a major source of financing for businesses. If lenders become more cautious, or if defaults rise sharply, then credit could become harder to get. And when credit becomes less available, businesses may slow down hiring, delay expansion, and reduce investment. That is one of the main ways financial stress can spill over into the real economy. This does not automatically mean private credit will cause the next financial crisis, but it is absolutely an area of the financial system that regulators, investors, and economists are watching much more closely now. In many ways, private credit has become part of what economists call the shadow banking system. That term sounds dramatic, but the basic idea is simple. It refers to financial activity that performs functions banks use to perform, but outside the traditional banking system. And that matters because stress in credit markets often builds slowly at first. Then, once defaults start to rise more quickly, conditions can change fast. That is why monitoring credit markets is so important. Credit conditions often serve as an early warning signal for the broader economy. We saw something similar in 2008. Back then, stress first appeared in parts of the credit market, especially subprime mortgages, and over time, those problems spread across the financial system. Now, let me be clear again. The private credit market today is not the same as the subprime mortgage market in 2008. The loan structure is different. The investors are different. The risks are different. But history does show that fast-growing parts of finance can run into trouble when economic conditions shift. And that may be exactly what we are starting to see now. The private credit industry grew rapidly during a long period of extremely low interest rates. But today, that environment is gone. Borrowing costs are higher. Economic growth is slowing in many areas, and investors are becoming more cautious. So the key question going forward is this: will the private credit market move through this period smoothly, or will rising defaults lead to larger problems? Right now, the evidence points to early stress, not a full-blown crisis. But the real question is whether this stays contained or begins to spread. Periods of rapid growth are often followed by periods of adjustment, and private credit may simply be entering that adjustment phase now. Still, because this market has become so large, its health matters not only for investors, but potentially for the broader economy as well. That is why economists, regulators, and market participants will be watching it very closely in the months ahead. I hope this helped explain what is happening in the private credit market and why it matters. If you found this useful, please subscribe. Thank you very much for the support, and I wish you a great day.